It's about really truly understanding the numbers. Because if I'm going to be real with you, profitability, you have to be intentional. It just doesn't happen. And the businesses that are the most profitable, they understand the numbers. They're looking at the numbers and they're making decisions around those numbers. So if you don't take that part seriously, how can you even get to an intentional conversation, intentional behavior driving profitability?
Welcome to Those Odd Numbers podcast. My name is Jason Snider. I'm the founder and CEO of Main Street Financial Group. We are your fractional finance team.
I'm Summer McFarlen. I'm a CPA and certified tax coach. I'm also the co-owner of Main Street Tax Group, where we do strategic tax planning so you can keep more of what you earn.
I am Masheka Turner, and I am the owner of Bright Skies Business Services. We are your outsourced accounting firm and profit first strategies. And we are here to help you create wealth through your business by gaining clarity around your numbers.
Welcome to another episode of Those Odd Numbers. Today we got a very interesting topic of how to set up your accounting and bookkeeping for success. Again, I'm joined with Summer and Masheka again today, and I think this will be a longer episode than we normally would do, because this is going to be a topic that we've all had almost a few decades of experience between us to elaborate on. So probably a lot of good stories as well, I think. So accounting, bookkeeping success, we were doing a little bit of a recording discussion amongst ourselves. And I think one of the things we're going to talk about, not just the technical aspects of relationship wise, even if it's somebody in-house versus outside accounting firm, and then the technical setup of using current technology, QBO, QuickBooks Online, Xero, things like that. Does anybody have a story they want to start with? Summer and I were just talking about clients we're currently onboarding that it didn't look like there was a lot or a planning put in place for a transition of the accounting or setting it up for success. One through growth, they grew to several locations, and then the other was an acquisition situation, but it was almost an afterthought, if you will. It's understandable given all the other complexities a business owner faces, but I think it's this one I would want to put this at the top of anything I was doing in an acquisition or leading a business, because if I don't have good reports, I don't know where things are going. Masheka, you have any, war stories or client conversations similar to that?
I guess we can go a little bit into it. I think one of the things that I see a lot of times that people are not set up for success is when people try to put multiple companies in one QuickBooks. And when I say multiple companies, I'm talking about multiple tax IDs. So of course, QuickBooks Advanced does allow you to do some things, but I'm mostly talking about just a basic QuickBooks file. And a lot of times I'll see where people I don't even know how this happens, but not only would they have personal 2 or 3 businesses in QuickBooks, but with all different tax IDs. But not only different tax IDs, also different LLCs. And I don't want to get too much into the legal side of that, but part of the reason why we're doing that is for protection. And if we're just going to mix it up on the accounting side, it's technically undid everything that you're trying to do to protect yourself. So that's something that I see a lot.
Yeah.
Listeners can go back and listen to the discussion we had about mixing business with personal, even though you're mixing businesses with businesses. I think they would learn a lot from that prior podcast.
Similar to like Masheka, the other one I'll add to it is they got personal, business, and the rental property all mixed together. The boat payments in there, the mortgage fee, the vacation to Disneyland, all ends up showing up because they attached the account to QuickBooks, because maybe there was a few transactions a month related to the business that they didn't separate out. And so whoever thought either a bookkeeper or somebody on staff or the owner decided to attach it to QuickBooks. And so I started entering all of those personal related transactions. And so it wasn't set up. Some of it's misunderstanding. I'll be kind that no, you don't get to deduct your boat payment, your personal car payment. There's other methods for that to get reported and processed through the tax returns. It should not be on your QuickBooks or your accounting system for your business, because it's been pointed out, that pierces the corporate veil, if you will. Our attorney friends would probably have more elaboration of how challenging that would be if you get in a situation where that's under the microscope, where it can cause significant amount of issues, and then also pierce for liability purposes. If you have a medical practice or other things like that, that you could extend business related liability to you personally.
One of the ways that I always approach it, and I don't want to get too technical of it, but a lot of times because people don't know, probably about 25% of the time, I do have people that have said, okay, what about all of the personal stuff that I bought on my all of the business stuff that I put on personal credit card or personal checking account? Usually how we approach that is, if it's a checking account with your personal name on it or a credit card with your personal name on it, it is never appropriate to connect it to QuickBooks. What I'll usually say is, let's go and download the transactions and do a journal entry to get them on QuickBooks, but never ever connect the accounts. Because again, this is business stuff. And once you start connecting those business accounts, not only are we speaking from a liabilities purpose, and Summer can speak to this, if there's ever an audit and someone looks at your books and they see your personal accounts connected to QuickBooks, then that means that the audit has also extended from your business to your personal accounts as well.
That's a very good point, Masheka. Yes.
So you're the CPA, so yeah, bring it on home with that.
You don't want to do, I can't, we've stressed it before, but I can't stress how important it is. If you have multiple businesses, you need to keep them separate. You need to keep the books separate. And again, no mixing personal expenses with business. Now, to go back to what Masheka said, I had all these things that I paid for before I had a business bank account and before I really got the business up and running. Those are usually startup costs. They're probably going to need to be amortized, but there is a way for us to get that information into your books so it's taken into account. But like you said, yeah, that's why I don't really do bookkeeping anymore. It's because
tell us how you really feel, Summer.
Because I've been so traumatized by having to untangle all of this stuff and get it fixed. And the client doesn't really understand why it took so long. And it's easy. I know what it is. And I'm like, I don't.
Where's your magic wand? You're just supposed to be able to
my magic wand and just fix it. And you spend hours and hours trying to fix things because they tried to save a little money in the beginning by not doing things right.
I think it goes to, we'll cover a little bit more on the relationship aspects of how some of these get started. But the way to, at least the way I would frame it is, you want to treat your business as a business. It's not your personal treasury. It should be treated separately, because at some point, almost everybody I talk to have vision that they want to pass along to somebody else through an exit. Whether that's viable or not is usually hasn't had that conversation yet, but almost everybody expresses they want to build it up and then they want to be able to exit and pass it along to somebody else. And the only way that's going to happen is if those business expenses stay business and those personal expenses stay personal. Because the moment you mix those up at any significant regularity is more the bigger thing. Just speaking from a former business broker's perspective, if it's ongoing, it raises a big question in the buyer's mind of what else is going on that's not visible to me either. If one practice is in place, it's likely that there's other things that the seller is not telling me about that I don't know about, and therefore I have less confidence in what the seller has shared to me and things. And so we'll just start there, is treat your business that way. I have noticed a significant difference in success of business owners that focus on the business as a business instead of their using it as their personal treasury for taking care of themselves, their family. And that's all reasonable. And reason why we get into business is one of the things is to provide for our hopes, dreams, our families and things. But how you do it is the more important thing. And so reiterating what I just mentioned is those who have those processes in place, who are keeping those separate intentionally and managing a business as a business and not your personal treasury. And part of it is tax code related. We all have mileage deductions and other things that we want to take advantage of, but how those things are done is very important for looking for an exit. Now, if you don't plan to exit, I still would recommend that you follow these practices, but it's not as important as how you detail it. You still want to have that same mindset though. And Summer will probably provide some more details that I'm maybe glossing over because I'm not in the tax side of things as much, but speaking primarily from an exiting business owner's perspective. Those would be the critical aspects and things to go from my perspective.
Yeah. I was just thinking while you were saying that several years ago, okay, I need to knock on wood because my clients have not been through an audit. We haven't had any audits in a while, but a couple of years ago, I know, actually more than a couple of years ago, I have one client. It all comes from not following the rules, right? They had an S corp. You're supposed to pay yourself a salary. He wasn't. I told him every year, why are you not paying? Why are you not paying yourself a salary? You need to do this. You're going to get audited. He got audited, right? So again, just for not following the rules. If he had paid himself a salary instead of taking $130,000 in distributions, that would have been a whole different story, right? So then we had to be dragged through this audit, and then they took about everything he had taken in distributions and recategorized them. The IRS recategorized them as wages. He had to pay payroll taxes on that, and he had to backfile payroll tax reports. And the fines were just almost as much as the salary that he did not take. So it just cost a ton of money for him. And then again, mix it, not following the rules, mixing personal. I had another client that lived beyond their means, took out a bunch of money as a loan, not through salary or anything, shareholder loan, with no intent ever of paying it back. So what does the IRS do? They come in, they audit this corporation and say, that's all dividends. So they reclass that whole shareholder loan to dividends. Again, we got to go back and do tax returns. You've got a bunch of penalties for understating your income at that point because it was so large. So it really helps to just do things the way you should do them. You're going to save a bunch of money down the road by getting some advice from a bookkeeper, a tax accountant, somebody like that can advise you on how you should be doing things.
And I think the reason mentioned earlier about the success of business owners who follow what I'm talking about or what we were just chatting about, I think it's because they focus their energy on creating value through the business rather than looking primarily for loopholes or ways that they can lower their tax liability. We only have a certain amount of energy, time, resources available to us, and you have to choose wisely what you focus your energy towards. And for me, where I see the success is those who focus on driving value for the business, whether it's growing sales profitably, whatever that value driver for the business is. You only have a certain amount of energy. That's where I would focus my energy than trying to be, I'll use the word cute with your practices around classification for tax purposes, pursuing strategies and actions just to minimize tax. Yes, we want to do that, but to the extent that it starts affecting driving value for the business, that's where the ROI drops. And that's again why the pattern of behavior I've seen, those who are successful focus on the business as that, and then they look at, hey, what's the compensation that I should collect for that particular work that I'm doing for the business? And then just look to that and not rate it for, rating the company bank account for their personal. They shouldn't be paired together mindset.
And then let's just be real too. We get it. Nobody wants to pay for bookkeeping. Nobody wants to do it. I get it. But it's not even about just having a pretty set of books to present. It's really about the power. I know, right? It's really about really truly understanding the numbers. Because if I'm going to be real with you, profitability, you have to be intentional. That it just doesn't happen. And the businesses that are the most profitable, they understand the numbers. They're looking at the numbers and they're making decisions around those numbers. So if you don't take that part seriously, how can you even get to an intentional conversation, intentional behavior around really driving profitability? So it's not just for the right now, but it's also for the future. Wouldn't it be great to tell, okay, I need to hire 5 people in 6 months? How do you even have that conversation if you have no idea where your numbers are or if your numbers are not correct?
But Masheka, that goes into advisory, right? When you're doing that additional, it comes down to bookkeeping, and I don't want to offend any bookkeepers because I love them. They provide a service, but there's some people out there just putting in numbers. They're not looking at anything like that. But Masheka, I want your advice. Isn't that more expensive? How am I going to afford that when I don't even want to pay for bookkeeping?
And so this is the way I look at it. And this is not me trying to sell anyone, but you say you can't afford that, but you really can't afford to be in the blind about your numbers. And let's just be honest. even if you have a small business, most businesses need a little bit more than bookkeeping. If this is me saying this, so don't call in and don't write in, don't get mad at me, but this is me saying this. Most businesses have a cash management problem, and that goes way beyond bookkeeping. And a lot of times, most businesses need a little bit more than bookkeeping. They need some advisory around cash management. They need some advisory around future decisions. And the thing about it is, you think you can afford it, but what is it really costing you not to tap into that?
Yeah.
Yeah.
Yeah. It's very, advisory is very, I think there's a lot of value there.
We could step more into the relationship aspect of this as well, because it does feed into many, at least from my experience, many business owners, why they've shied away from engaging at a higher cost level, maybe from their perspective, or a higher investment level with an advisor, with a CPA firm, with a bookkeeper, is bad experiences. And one of the things that you can test with, if you're looking for somebody to work with, is align with what you're looking for around responsiveness, how the engagement works. I would say those who provide a fixed fee arrangement or a monthly charge setup are going to probably be more value led than the hourly billing. It's just my experience. What I've noticed over the years being involved in this industry, outcomes tend to be better when it's a more previously defined pricing amount, because for me, it tells me two things. One is the firm owner has done the calculations and figure out where their value lies and what it costs to produce that value. And so they're going to set that amount. And then two, the more important thing for me is it sets a better tone for the relationship. So if you're paying per hour, I'm not paying for time. At least if I was a business owner, it's not as interesting to me that I'm buying your time. It's more interesting, what can you help me with in my business and drive that value? That's ultimately what we're doing. And for many years, professionals have used time as the currency, the only way that they can really value their time, and probably came from practices before when we had technology and other things that are a lot more effective at capturing and being able to price and other things like that. But it's going to default, and I see a lot of firms starting to migrate towards the value pricing, as some people call it, but a fixed fee arrangement engenders a better relationship in my experience as well. Almost all of the clients we onboard that have had a negative experience with their previous advisor, accountant, tax firm has been the hourly billing arrangement, where they are not confident to approach them to ask questions because they know they're going to get, in their view, dinged for X number of dollars for a 7-minute call that turns out to be a 15-minute bill for. And so it genuinely causes business owners to consider, what's really the value that I'm getting from this. And they'll look at it more focused. And I haven't, and from my perspective, I've been doing value pricing since 2010 on all my work since then, and even in our business now. And since I switched to that, the relationship dramatically improved with clients where they were more engaged. Not all of them. There's still people who show up at the end of the year and told me they did this, and we have to try to go help them out as best we can in those situations. But it's definitely improved the relationships with the clients that wanted to be engaged and proactive and things. And so some of it's a little bit industry driven, where it's not focused on outcomes for clients. Then it's just, how much time are you using for me so I can bill you for it? Coming back to the relationship part, I think that's what I think all of our firms, we do some type of a value pricing arrangement to engender that relationship. Now it's up to the client to step into that and be communicative and be proactive as part of that. And that's what I think we're all trying to do in our firms, is allow that proactive client who wants to be engaged to bring that value to their business for working with us.
So and with that being said, I think it will be helpful to maybe talk about maybe some indicators on the front end, if that's going to be a good fit, because you are right. I talk to a lot of people, and a lot of people have been burned. A lot of people have been overpromised and underdelivered. And so I think now is a good time to kind of talk about some things to look at on the front end. Some of the things that I have found, like Jason says, definitely value-based pricing. So you don't have to worry about, am I going to be charged extra for this, extra for that? But some of the things that I have found very helpful, because we have niched down, and there are just some clients that we just say they are a no for us. And even though I say they are a no for me, it's really a no for the client. There are some clients that we flat out are just not a good fit for. We cannot serve those clients. And I'll just say for me, like manufacturers, constructions, those are automatic no for me because I believe that they are better served with somebody who is working more with those clients, has a better understanding, and can devote the time that they need. And I think those are real conversations. I work with a niche, and I like it when a lot of times I'm talking to the client, 99% of the time, I have solved that problem with another client and have been able to solve it. So I can speak to what their problem really is, even if they can't put it into words because I saw it. So I think that's always a good thing is looking for someone in the niche. Read the reviews. I know people don't always leave reviews, but read the reviews. What are people saying about that client? And of course, an introduction from a current client is always something that should be paid attention to. Hey, I work with, let me give you their number. I think that's always a good indicator. But what can you look for on the front end? Because sometimes relationship is doomed from the start.
And you bring up a couple of good points there. Niching definitely helps. Yeah, on the converse, I would say, for speaking, if there's accountants listening to this, is if you're not comfortable or you're not sure, definitely look for that. There's plenty of other people who have experience or a niche in that area that can get in. In our area where we have a lot of clients in e-commerce, we see it unfortunately consistently where the firm that they've been working with assumed that they know how to do e-commerce accounting. It's not the accounting principles that change, it's the technology integrations and how they input or bring in data from the various sources and how it needs to be conformed. Do you need every single sale on your Shopify or Amazon store to show up on your QuickBooks? No. But we see integrations and other things that are built and being supported by accounting firms that are costing the client a significant amount more for their billing because they're doing every transaction. And that's an example of, and it's also on us, as you mentioned, Masheka, to turn away or redirect those clients those prospects that we may not be able to best serve, that we can point them and refer them to. And that's something we do quite regularly when we get clients that are in areas that we're not familiar with, that because it's more complex tax-wise. Sometimes California falls into that. New York is another state that they're going to be better served by somebody who has more experience with that because it's more complex and we just don't have the time enough clients to spend time keeping up on all the tax laws and changes. And then also the reporting requirements and things, and they're going to be better served by somebody who has those experiences and things. So the questions you mentioned, Masheka, some of the things I would look for would be ask them questions. Do you have experience doing this? That's a fair question from prospect business owner to an accountant. Do you have it? And whether they have direct experience or not, it's more about can they respond and communicate of where they're at and what their experience is. And then if they want to try to work in that area as well. And so that would be one. And then for me, it's the number one item I get feedback on clients from or our new clients on their previous experience that were bad. It's communication. It's how quickly they respond. If you're going through a get to know each other process and evaluation, and it takes them a week and a half to respond to your setting up a call or something, it's probably a good indicator. Yeah, fair enough. If it's in tax season, that's going to be a process. But also, if they're that busy during that period of time, are you going to be able to get to your service that you are asking for if they're going to be super busy for 2 months and not be able to respond? It's also a factor, wrong or right, it's a factor that needs to be considered as you're evaluating an accountant or a bookkeeper. And then for those who are hiring for bookkeepers, there's a couple resources for, I think it's Accountants Test. I don't remember that, but they offer a platform where you can purchase tests and you can provide that to your prospective bookkeeping candidates to see that they have the technical competence. Because many of the stories that we could share, but might really share too many details about the particular client, is people who think they know what they're doing, but unfortunately don't technically. It's not as simple as just getting a transaction into QuickBooks. There's a lot of other things that can happen that get posted to, maybe you can reconcile the cash account, but things that should be on the balance sheet are on the P&L and vice versa. I think I saw a real estate deposit of like $140,000 on a person when we were doing a review. That was on the P&L when it's a security deposit and things. So there's a lot of So use the term poor bookkeeping practices out there and things. And so test is one way if you're doing the hiring for somebody on staff that you can utilize as well.
I'm glad you actually brought that up too, because I don't see it so much now. But one of the things that I was seeing a lot was anybody can do this. There was a lot of bookkeeping online classes. And this is the thing, and I'm not here to down anybody, but I will say this. Bookkeeping and GAAP, genuinely accepted accounting principles, are not the same.
Right.
And so just because you can operate QuickBooks or Xero or Sage or whatever system you're using does not mean that you understand GAAP or genuinely accepted accounting principles. There is a difference, and that difference can cost you if your books are not set correctly.
And there's, like we were talking about before we started recording, was many of the terms and processes were set up in the days when we did paper T accounting. And I think we still have our notebooks when we pull that out to see what's going on. For those prospective bookkeepers or people hiring, you want to know that they understand what's going on behind inside of QuickBooks and Xero. Because most of the failures I see on the technical side are, I'm knowledgeable in Xero and QuickBooks, I passed their test, but when there's an issue, when they're presented with an accounting issue, the solution actually creates more problems in some cases because a misunderstanding of how it's going to be applied inside. So you need those basic skills of down to T accounts in some cases to be able to resolve. And it's one of the things we test for in our firm when we're hiring is basic accounting bookkeeping skills outside of the software. We actually don't really care as much about the experience in QuickBooks or Xero because we'll train for that. It's harder to train for the basic accounting bookkeeping skills these days because there's all over the place to be able to get QuickBooks and Xero trainings, and much of it's free actually through YouTube by the particular software providers as well.
And just because they say they're an accountant, they may not know what a debit and credit is. There are some out there that they don't do this, right? They don't do bookkeeping. They're analysts or something else, and they don't know what a debit and credit is. The word accountant does not always mean the same thing industry-wide.
And we were talking about definitions as well. Accountant, bookkeeper, I think a lot of these terms came from the paper accounting days where a bookkeeper would be the ones booking inside of the book, if you will, and logging those transactions. And the accountant would be the one who took those journals, if you will, at the end of the month and did the closing process and things. And so there's actually two separate functions that needed to happen these days with the electronic general ledger systems like QuickBooks and Xero, which are effectively posting every single transaction in real time to the general ledger, which didn't happen in the non-digital days of accounting. It's become almost the same. You have to have that discerning at the time you're posting the transaction of where it's going to show up when you choose the account, because it's going to go straight to the general. You don't get a second look through unless you've got a robust reconciliation and month-end close process to catch those errors.
But I accepted the transactions into QuickBooks. Doesn't that mean I reconciled everything?
Yeah, of course.
Liar.
That's another thing we should talk about. That's more recent is and without naming any specific software providers, inside of the inroads of AI to these platforms has actually generated more issues where we've had to go back and institute some more robust backups and things, like even downloading every month the trial balance and general ledger to a PDF or some other external outside of that QuickBooks platform so that we could have a backup, because there's been duplications of transactions sometimes 7 or 8 months after we've closed that particular time period that then all of a sudden pops up and the bookkeeper is like, hey, I didn't enter that in there. I know we didn't. And we can go back and look because we downloaded the GL and the trial balance to just have something to reference back we've had to adjust some processes because of the destabilization of some of the platforms with trying to push a lot of AI into these work engines and things.
And then I'm gonna be honest with you too, and I'm like you, so I'm not gonna throw anybody under the bus.
I will.
But one of the
that's all day long.
One of the things that I think is misleading is a lot of the commercials.
Yes.
They make it look like you just log on and you hit a few clicks and clacks and you have solid books. And we can probably all speak to, we make a lot of money because this system, if I'm gonna be honest, and I'm not knocking it, most accounting systems are not very intuitive. and you don't do a few clicks and clacks and have solid set of financials. I hate to say it, but that's just not the way it is. I've never seen any system that you just click and clack and you're ready to go. And you can get to a point where you can add a bunch of automation in, but even that is not intuitive. You have to know what you're doing to even set that up on the front end.
You kind
And
of
you have to
know
understand
how accounting works. That's what
that's
you're
it.
saying.
That's it. Not only do you have to know what you're doing from a software perspective, you also need to understand GAAP accounting. And I'm not knocking anybody, but the average business owner is not locked in like that. They understand their business, not this.
And some of them have TikTok accounts as well.
Oh, yeah. That's another episode. The TikTok.
Those who know that's our code word in the industry. TikTok accounts is generally somebody purveying a lot of, in some cases, totally incorrect advice and making it sound kosher and acceptable.
So I'm glad that's finally kind of cut out a little bit. I think people have kind of been waking up from this and they realize most of the time the advice they're giving is not so much that it's wrong, it just don't apply to 99% of the people that's trying to use it.
Even the IRS is starting to crack down on these people too. And they also recognize they're auditing people who have listened to these TikTok experts. And there are some people that they're having to pay some pretty hefty fines.
And this might be a good time to lead into what we were talking about earlier of setup, or was mentioned earlier, setting up a brand new accounting system. We've all been involved in having to set up an existing business because of issues in the accounting or the process that were used to build the QuickBooks or Xero accounting. So setting up is a very important part of it as well. And it's to the point of if you're making an acquisition or if you're growing fast, what got you there entity and business-wise and accounting-wise likely isn't going to continue supporting that as you grow. And we've both run across issues, I think Summer and I in the last week, where these issues, significant amount of money is at stake around the 8 figures mark in both of these cases that are going to be at stake over a period of time, not in a single year. But yeah, it's going to be a significant amount of money that could be at stake as far as because the setup, there was either misunderstanding that they could do a certain thing and then they thought they had it figured out and it's turning out not to be the case, to growth outstripping the current setup and maybe a little bit more lackadaisical or unknowledgeable about it. And both had some level of engagement with a professional to help them go through those things to some degree, whether the questions were asked correctly or that everybody understood, who knows for sure, but it wasn't done the correct way. And I think a little bit more to be diligent out there. I think it comes down to the relationship, because if you can spend the time and go through things and know that you have confidence in it, in the relationship, then ask those questions and get the competent advice so that you don't have to undo things later on. As Summer said, we've made a significant amount of money. We would rather put it towards something that's more ROI generating than it is going back and being compliant income generation for us. But we do need it for us to do the work that most businesses want us to do, is how to increase profitability and valuations and wealth for everybody that engages with us. And compliance is one aspect of that. None of us particularly enjoys, but has to get done. And so we want to get it done right so that we can focus the 80-20 almost of 20%. If we get it right, we can spend most of our time and engagement on driving value for everybody than purely compliance level.
Yeah, we really prefer to help you grow your business as opposed to having to go back and fix some things and then grow your business.
Yeah. And so the word would say, assuming that you've got a good relationship and you're confident in your advisor, that you go to them proactively. And that would be another good indicator of a competent advisor, accountant, tax advisor, is do they offer quarterly check-in calls or other things like that? It's part of their process engaging with clients. That would pretend that they're focused on value, driving value for the relationship, than just end of year tax compliance and, hey, let's get everything ready so we can file your taxes, which is obviously necessary. But in the long term, you want to drive value for your business. And that's, I think, really the only way, is having consistent reviews, being accountable for what's going on in your business.
I agree.
And really, I think I can speak for all of us when we say that we would love to have regular check-ins with our clients and have them tell us what's going on, what are you planning, because we could be so much more proactive if we have regular check-ins and things like that with clients.
So actually, we require regular check-ins. If you are a client and you can't meet with us or you keep pushing us off, you're usually not a good fit for us. And I'll tell people that on the front end, and I'll tell you why. So a lot of it is just not good for you as a business owner. But to be honest with you, it also makes it hard on this end. When you're several months behind, when you need to get stuff that when you've made requests that go unanswered, it just makes it harder on this end. And so we've actually uninvited some clients because even though they're paying and they're paying on a reoccurring, because we just know that you're just not a good fit. We like you, but you're just not a good fit. And what I really want to do is not only help you grow your business, I want to help you build wealth through your business. And all of that is very intentional. And if you can't make time to even meet regularly, then we just can't do that.
Good for you, Masheka. I like that.
Yeah, that's a good indicator because it fits with the behaviors that we were just talking about earlier about habits. And I think that's going to be a future episode as well of habits of successful businesses and entrepreneurs that we've observed in our work. And I would say that's one of them is having those habits built into weekly, daily, monthly, quarterly, annually. They don't need to take a lot of time, but they're there. They can drive a lot of good value for you and your business.
And I think at the end of the day, all of us got into this business to help people, right? We want to help people. We want our clients to be successful. So if we don't have any communication with you, we're not really helping you.
Even if you're paying for it, if you're not utilizing it, we're not helping you.
Yeah, that's crazy. You're paying for it and you're not even getting your value.
Yeah, to me, that just lets me know that we live in an abundant world and there is way more money because if people are willing to and not even get what they pay for, that just lets you know there's a whole lot of money in the world.
Any final, this is probably our longest episode, and we warned you at the beginning that was going to be a meaty one. Any final thoughts to share before we end today?
No, I think that's it for me.
Yeah, I think we're good.
Yeah.
Just a reminder, you can listen to this at 1.5, 1.75, and it'll speed it up.
Yeah. You utilize technology to increase absorption. Yeah. So we'll finish up today. Thanks everybody for listening to another episode of Those Odd Numbers, and we will see you in the next episode.
This content is for general informational purposes only and is based on current law and guidance as of the date of recording. Tax law and regulations are subject to change. This discussion should not be considered tax, legal, or investment advice. Listeners should consult their own tax or financial professional regarding their specific situation.